QQQ is an ETF put out by Invesco. It tracks the NASDAQ 100 index, or basically the largest 100 companies based on market cap inside the NASDAQ. On the other hand, VGT is the Vanguard Information Technology ETF. Unlike QQQ, this is an ETF that only invests in the technology sector. While the goal of QQQ is to track the NASDAQ 100 index, the largest 100 companies inside the NASDAQ composite, this ETF actually tries to track the MSCI US Investable Market Information Technology 2550 index. That sounds like kind of a mouthful, so what does that actually mean? So basically there's something called a GIS standard. And so MSCI creates indexes of stocks. They create the methodology that these companies use to find the stocks and try to track that index inside the ETF. So essentially it's really easy to understand this. Basically MSCI goes out and they find all the different potential stocks that fall into the technology sector based on that GICS, and then they basically just invest in the tech sector stocks. Now there is that thing about 2550 index, and that's something that you don't really need to worry about, but basically if you take all of the stocks inside this fund, no one stock should be able to be more than 25%. That was one of the things that they talked about. And the other one, basically half of the stocks in the fund cannot be more than 5% weighting of the fund. That's it. That's basically what they're saying. So it's going through all the tech sector, but it's got those two little nuances to it too. That's how they basically create this index. Okay, so in terms of VGT versus QQQ, let's talk first about the expense ratio. So here you see the two ETFs. They're comparing each other here. And basically, you'll see down here the net expense ratio of VGT is 0.10%. So it's actually less money to own VGT than it is to own QQQ, which is 0.20%. So to start, you might say to yourself, okay, why are you spending more money to own QQQ than VGT? Does it really do a better job? Is it going to make you more money going forward? So that's a question you might want to ask yourself. So let's move on and say, okay, the total assets of both of these, they're both huge ETFs, 52 billion in VGT and QQQ, 174 billion. So much larger for QQQ, but still VGT is a giant ETF in itself. This next part's probably not that interesting to you if you're really investing in tech-related companies. You probably don't care that much about yield, but let's talk about it anyway. So the distribution yield on VGT, 0.81%. Essentially think of that like a dividend yield. So how much money do you get back via distributions by owning this ETF? And then QQQ is 0.59. So you get a little bit of yield in these, not a lot, but you do get some. And in terms of the portfolio, of course, QQQ, you have less stocks in that because QQQ is only investing in the NASDAQ 100. What's the number there? 100, right? 100 different stocks. So QQQ should have 100 stocks. It's got 102 in here. I don't know why there's a second one, two other ones in there, but it's probably maybe like just like a temporary thing. We have 102 showing on Schwab. VGT here has the total holdings of 378. So this has a much larger cross-section of the technology sector than VGT does. Now, while that's interesting, another interesting part about this is that the percent of the top 10 holdings, the top 10% largest holdings inside the ETF, VGT actually has more in the top 10. So essentially a higher weighting of single individual stocks in that top 10% than QQQ does. So interesting. QQQ is a bit more diversified in terms of the top 10 holdings, having a little bit less in that top 10 percentage. So in terms of the top 10 holdings, which I was just talking about, so basically we have VGT, which has Apple as number one, and QQQ, which has Apple as number one. VGT, 24% of that is inside Apple. That's a lot of money inside one stock. QQQ has 13% in Apple, right? And this is kind of what I was saying before, less money in that top basically stock, right? So the top 10 different stocks. And Microsoft is next to 18% in VGT, only 10% in QQQ, Nvidia, then Amazon, and QQQ. And here's the other thing that I kind of want to get across here is that only one of these is strictly tech. The other one, QQQ, is going to have different sectors inside of it. So in theory, actually, Visa is a tech company according to this. Then you have MasterCard, AVGO, Broadcom, so you have semiconductor, you have Accenture, you have Adobe, you have Cisco, you have CRM or Salesforce, right? Now, those are technically all tech sector companies. Then you have Amazon, which is not a tech sector company, which is in QQQ. You have Tesla, which is also not considered a tech sector company. You have Google, which is weirdly enough not considered a tech sector company, right? So you have a different type of companies in here. Pepsi, it's not considered a tech sector company, right? So QQQ is not going to only be tech. You're going to get more of a diversified sector mix inside of QQQ. In terms of the sizes of the companies that are inside these portfolios, the weightings of giant cap is 60% for VGT and it's basically 60% for QQQ. So they both have about the same amount of weighting inside giant cap companies. Large cap companies, VGT has a little bit less than QQQ. Then we have some medium cap companies, so we have a little bit more medium and small inside VGT than you have in QQQ. So if we take a look at the performance of these different ETFs, we could see that the compound annual growth rate going back until when this thing goes back to, which is December 31st of 2004, we have a compound annual growth rate for VGT at about almost 13%, 12.99%, and QQQ 12.95%, so just under a little bit less of a CAGR for QQQ than VGT. The standard deviation, so there's a little bit less risk inside QQQ than there is in VGT. The worst year for these two, there was a negative 42.81% for VGT and a negative 41.73% for QQQ. So a little bit less of a drawdown in QQQ. So you lost a little bit less money, or your amount of money that you had in your ETF dropped by a little bit less in QQQ, but essentially it's like the same amount. You have a max drawdown, so during this whole time period, what was the worst time period from the very peak to the very bottom inside a time period essentially, and that was a negative 50% for VGT and negative 49.74% for QQQ. So essentially those are also the same. Now some years QQQ outperforms VGT and vice versa. So here you can see VGT is the blue, QQQ is the red. VGT outperformed in year 1, VGT in year 2, QQQ in year 3. VGT lost more in year 4, so QQQ actually did better, and so on essentially, right? So before we're going to December, the end of December of 2004, if we look here, we're going basically to the start of 2004 going forward, and you see QQQ actually outperforming VGT according to TradingView. This is with reinvesting the dividends inside the ETF, so this is the total return you would have had if you had invested back in 2004, held it to today. You know, a lot of money, 833% on your money. Of course, that's an amazing return. Now watch this. As we go forward in time, we can see QQQ and VGT pretty much for the first, let's say, I don't know, multiple years. QQQ is actually outperforming VGT. And then it kind of turns a bit of a corner once you get about like past, let's say, 2010 period. So once you get around here, VGT starts to pull ahead a little bit, and it continues to basically stay on top. And you can see VGT pretty much outperforms over the next, let's say, 10 to 12 years going forward. And it's interesting to me that VGT did so well over the past 10-year period, 12-year period after about 2010 than QQQ did. And so look, when you talk about what ETF is the best, of course, when you start out, you just look at the returns, you look back, you say, hey, this ETF did better than this one over the past 10 years, so this is a better ETF. But that's not necessarily the way that we should be doing this. It's really more about what do we think the mix of the sectors, for example, that these stocks or these ETFs invest in? Or what do we think about the sizes of the companies that these ETFs invest in? What do we think about that going forward right now? This is kind of how we need to decipher which one we think is going to be better. We also, of course, need to factor in things like the expense ratio, right? So VGT, of course, has a lower expense ratio, so it does win on that. And there also might be time period things. So if you're looking at the time period of what's going to happen in the next, like, say, like 2 to 3 years, if I'm going to make a decision there, I actually think QQQ is going to do better. And that's because I don't necessarily think the tech sector going forward the next few years is going to necessarily outperform QQQ, because QQQ has all these other different, not a lot of other sectors, but a few different sectors in it as well. And it's got some of these companies like Google that is not in VGT. So that's kind of in the short term. But in the long term, what do I think? Well, I think the tech sector is probably going to do really well, 10, 15 years down the road. And I think VGT will have better exposure to the tech sector going further down the road. So what my answer to this whole thing is basically, if you're taking a look right now at the next few years, I don't think VGT is going to beat QQQ. If you look further down the road and you really think that tech sector is going to be the better sector, one of the better sectors inside the stock market, I think that probably VGT is going to do a lot better 15, 20 years down the road, okay? Let's say 10, 15 years down the road. So that's what I think. So in general, two different ways to look at it. It could be VGT if you're looking more long-term, QQQ, maybe you're looking more short-term. And that's my thought on this. So if you like this video, please hit that like button, subscribe to see more videos like this, and watch another of my videos coming up on the end screen right now. Thanks everyone so much for watching. I do want to remind you I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.